Overall, we think that 2021 is likely to become another positive year for the precious metals complex.
Welcome viewers to this video session for One-to-One Mining Investment Africa. Focus of this presentation is on precious metals, specifically the outlook for gold, silver, platinum, and palladium. I'm pleased to introduce Kirill Kirilenko, who is the senior analyst for CRU covering precious metals. Kirill also edits the Precious Metals Market Outlook. Kirill, thanks very much for joining One-to-One to provide an outlook on precious metals. Please take us through your analysis.
Hi, Adam. Thanks very much for the invitation, and hello everyone. So let's have a look what 2021 has in store for the precious metals. So the presentation consists of three sections. After a brief recap of 2020, we will have a quick look at the macroeconomic background for 2021, and I will then share with you a high-level overview and the short-term outlook for each individual market. The whole presentation will take about 20 minutes. So 2020 proved to be a very strong year for the precious metals complex. Prices of each of the four major precious metals increased. Gold and silver benefited handsomely from demand for capital safe havens on the back of the global anxiety sparked by the pandemic and rising concerns about currency debasement amongst investors following the unprecedented liquidity injections by central banks in response to the economic recession caused by the fast-spreading virus. Driven by a confluence of these drivers, gold prices set a record high of $2,067 per ounce in early August, before retreating to lower levels. Overall, gold prices averaged $1,769 per ounce in 2020, up 27% year on year. Silver suffered more than gold in the aftermath of the March sell-off, but managed to recover rather quickly, benefiting from the spillover effect from the gold rally, and rocketed once gold started to look overbought. Silver prices averaged $20.55 in 2020, up 27%. Meanwhile, palladium continued to draw support from its tight fundamentals, benefiting from the faster than anticipated recovery in car manufacturing in China and tightening emission standards. A confluence of these drivers helped it add 43% to its value, as it averaged $2,192 per ounce last year. Platinum lagged, with prices spending most of the year below the opening level due to a substantial supply overhang. It was not until early December when platinum prices finally managed to move into the black for the year, after they were propelled higher by the news of another significant incident at Anglo Platinum's processing facilities in South Africa. The news sparked concerns about availability of refined metal, which in turn catapulted platinum prices by over 21% in the span of just 1 month. Thanks to this end-of-the-year rally, platinum prices averaged $883 per ounce last year, up 2%. Last year's substantial increase in liquidity on the global financial markets also benefited non-commodities. For example, the US stock market, represented on this chart by the Standard & Poor's 500 index, averaged 11% higher year on year, on the back of a massive monetary stimulus provided by the Fed. In contrast, the US dollar weakened by 1% year on year. The global reserve currency benefited enormously from its safe haven status during the most acute phase of the pandemic in March, but began to weaken following the unprecedented in scale and swiftness monetary response from the Fed. Speaking of monetary stimulus, unprecedented liquidity injections by central banks raised concerns about currency debasement amongst investors, whilst heavy interest rate cuts by the Fed and some other central banks pushed real interest rates, represented on this chart by the yields on 10-year tips, into the negative territory. This was probably one of the most important developments for the precious metals markets in 2020's macroeconomic background, as it dramatically reduced the opportunity cost of holding precious metals, making them more competitive with other interest-bearing financial instruments. Now that we have refreshed our memory, let's move on to what to expect from 2021. Assuming the worst of the pandemic is confined to 2020, this year is seen by many as a year when the nascent economic recovery could get on a stronger footing, helped by the rollout of vaccines, which should help economies to reopen. However, much will depend on the efficacy of these vaccines in a real-world environment, the speed and effectiveness of their production and distribution, and ultimately the pace of development of herd immunity. So far, only 3 vaccines have showed high levels of efficacy in stage 3 trials. US, Europe, Japan, and the UK have pre-ordered sufficient volumes to vaccinate most, if not all, of their populations. However, production of these 3 vaccines will cover at most 1/3 of the world's population by the year end. There are 2 more vaccines available to the market developed by the Russian and Chinese scientists, but we have no data about pre-orders. The next 2 charts are the extracts from the macro survey, which CRU conducts across its clients at the end of each year. The results you see are from the survey conducted in December. The chart on the left-hand side suggests that the majority of our respondents expect vaccines to allow economy reopening sometime in the second half of this year. However, the results differ between the regions. It seems that those of our clients who are based in North America are the most optimistic, as they expect reopening to take place in Q3 or even Q2. In contrast, clients based in Asia are more pessimistic. The majority selected Q4, but a quarter of respondents also selected 22 and beyond. The second chart shows how optimistic our respondents are about the global GDP growth in 2021, after a 4.3 contraction registered last year. Median answer is that the global economy will rebound by 4 to 5%, which is slightly lower than the projections of our economists, who forecast growth of 5.3%. Now let's have a quick look at the two of the key drivers for precious metals prices, the US dollar and interest rates. On this chart, you can see CRU's outlook for the global reserve currency. Estimates of fair value suggest that US dollar could be 5 to 10% overvalued against the euro. Vaccine rollout suggests that safe haven demand for the US currency may weaken this year. We therefore expect modest depreciation of the dollar against a trade-weighted basket and the euro. And the final chart from this section is focused on the Fed's interest rate projections. Monetary policy will focus on supporting the recovery, not inflation. That means no increase in policy interest rates and potentially further QE if the recovery slows. On balance, the macroeconomic background in 2021 continues to look supportive for the precious metals complex. Despite the promise of a vaccine becoming widely available, the levels of uncertainty about the future path of the global economic recovery are still high. The dollar is likely to weaken somewhat, while real interest rates are expected to remain negative through the course of this year. Now that we have set up the scene and talked about the macroeconomic background affecting precious metals markets in 2021, let's shift focus on each individual market. Before we begin, I'd like to draw your attention to the fact that all market balances you will see today are fundamental balances. In other words, they are ex-investment. So let's start with gold first. The physical gold market has been one of the most fundamentally unbalanced in the commodity space for many years. Massive above-ground stocks coupled with rising mine production have created a substantial supply overhang, the size of which is far larger than industrial users and official sector alone are able to absorb. The balancing act, therefore, must be conducted by another group of market participants, investors. The impact of the COVID-19 outbreak was negative for both gold's supply and demand, but demand suffered disproportionately more. Driven by a sharp fall in both jewelry demand and purchases by central banks, the gold's market fundamental balance fell deeper into surplus. Expectations for the gold market in 2021 are bullish. Despite the promise of a vaccine becoming widely available and the associated positive sentiment surrounding the global economic recovery, it is still too early to conclude that the pandemic is under control. Depending on the risk profile of investors, gold is likely to remain an important part of investment portfolios, particularly in developing economies. The bullish case for gold is further strengthened by the ongoing expansion in monetary easing programs by major central banks and extensive government fiscal stimulus in response to the economic downturn caused by COVID-19. These developments are supportive as they lead to low or negative real interest rates, making gold a non-yielding asset more attractive for investors by reducing the cost of carry. Finally, numerous geopolitical risks that continue to simmer in the background will help maintain investors' appetite for safe haven assets, including gold. The combination of these drivers should provide a strong tailwind for gold prices, which we expect to average $1,920 per ounce in 2021. Moving on to silver. Silver prices are also expected to strengthen in 2021, potentially even outperforming gold, as silver may find itself in a rare situation when it can draw strength from both of its identities, that of a safe haven asset and an industrial commodity. I have just described the drivers of safe haven demand for gold, which are also applicable to silver, so I'm not going to repeat myself here. Speaking of industrial demand for silver, the start of the post-pandemic global economic recovery should boost metal purchases by manufacturers of electronics and other industrial applications. Although this may not prevent the market surplus from expanding this year, it may bolster producers' and investors' confidence in this market and push prices higher as they restock. The combination of these drivers should provide a strong tailwind for silver prices as well, which we expect to average $24.68 per ounce in 2021. Now let's move on to the PGMs. Both platinum and palladium are heavily dependent on demand from the global automotive industry. Despite being hit hard during the first half of last year as a result of the pandemic, the industry demonstrated a remarkable ability to recover. During the second half, monthly production was above 2019 levels in China and close to that level in US and Europe. Nevertheless, output of light-duty vehicles dropped by 17.5% in 2020. 2021 will see strong year-on-year growth of 16%, but will still fall short of reaching the level of 2019. Even so, the expected rebound in vehicle output is positive for the PGMs, which should also benefit from the ongoing tightening in emissions standards, as they tend to boost average metal loadings in catalytic converters where these metals are used. Regardless of the short-term positive impact of COVID-19 outbreak on levels of urban pollution, it is likely to remain a major environmental risk in the foreseeable future. Tighter emission standards will continue to be introduced in various regional car markets over the next few years. Among these, car markets in China and India are of particular importance, as they are going through an intensive phase of regulatory changes to catch up with the latest standard implemented in Europe. The EU's regulators are also still tightening standards. All these legislative developments will not only give a boost to average PGMs loadings in the short term, but will also act as a tailwind for growth in demand over the foreseeable future. In 2020, the platinum market was pushed into deficit for the first time in 5 years. However, this abrupt shift was not a result of the industry suddenly finding an effective way of dealing with its long-standing supply overhang. Instead, it was driven by a sharp drop in availability of refined metal, caused by disruptions in South Africa, where both mining and processing activities were severely impacted by the COVID-19 related restrictions and technical challenges faced by one of the largest platinum miners. The fundamental weakness of the platinum market is unlikely to dissipate anytime soon, and will weigh heavily on prices again when processing and mining capacities get fully back online in the second half of this year. The unresolved situation with high and rising market surpluses, as well as the lack of improvement in fundamentals in the short and medium terms, is likely to keep investor appetite for platinum subdued for several more years. We forecast that platinum will continue trading in the established trend below the 1000 level. It may still breach this threshold on occasion, but venturing much higher from this figure on a sustainable basis may prove to be difficult. For that to happen, the fundamentals would need change significantly, and this may take a few more years. We expect platinum prices to rise by 3% this year to average $902 per ounce, predominantly driven by the spillover effect from the gold rally and somewhat stronger first half of the year, when prices are expected to be supported at elevated levels by the ongoing liquidity issues in the refined segment of this market. The last metal we are going to look at is palladium. Although the palladium market moved closer to balance in 2020, thanks to a negative demand shock caused by the coronavirus outbreak, its fundamentals are unlikely to change markedly in the medium term. Assuming the worst of the pandemic is confined to 2020, most automotive and global palladium demand should recover this year. However, the release of metal accumulated during 2020 from Anglo Platinum's pipeline is likely to add to the market liquidity and pressure supply deficit even lower. Although this market development may slow down palladium's rally, it's unlikely to reverse it. Prices are expected to rise by 5% this year to $2,293 per ounce. Overall, we think that 2021 is likely to become another positive year for the precious metals complex. Prices of each of the four major precious metals are expected to rise, albeit not as much as last year. The rollout of COVID-19 vaccines is expected to make 2021 less affected by pandemic-related disruptions than 2020. This should have a positive impact on both economic and business activity, which should in turn support precious metals with a more industrial core, such as the PGMs. We expect platinum and palladium annual averages to rise by 3% and 5% respectively. However, it is still too early to conclude that the pandemic is under control. As such, the metals with safe haven credentials, such as gold and silver, should continue to benefit from the elevated levels of uncertainty regarding the path of the global economic recovery. Our expectation for the gold price is a 7% year-on-year increase. We are most bullish on silver though, and expect it to rally by 21% year-on-year, as it draws strength from both of its identities, that of an industrial commodity and a safe haven asset. Finally, I'd like to say that today's presentation was a high-level overview of our vision of the precious metals markets in 2021. For those of you interested in in-depth analysis and more detailed discussion of these markets, as well as CRU's longer-term outlooks, please feel free to get in touch with myself. My contact details are on the screen. Thank you very much for your time and attention.